Ultimate Guide for Beginners on Robo-Advisors offering fractional shares and micro-investing in 2024. Step 1. Understand what fractional shares are. Fractional shares are small portions of a single share of stock, allowing you to invest in a specific company with a smaller amount of money. This is especially useful for beginners who want to invest in a particular stock but don't have the funds to buy a full share. Step 2. Research robo-advisors offering fractional shares. Some popular robo-advisors offering fractional shares include Robinhood, Fidelity, Charles Schwab, eToro, Stash. Step 3. Choose a robo-advisor that fits your needs. Consider the following factors when choosing a robo-advisor. Fees. Look for low or no fees for trading, management, and other services. Investment minimums. Some robo-advisors have no minimum investment requirements, while others may have higher minimums. Portfolio options. Consider the types of investments offered, such as ETFs, mutual funds, or individual stocks. Mobile app. Choose a robo-advisor with a user-friendly mobile app for easy trading and monitoring. Step 4. Sign up and fund your account. Create an account with your chosen robo-advisor and deposit funds using a variety of methods, such as bank transfer, debit card, or wire transfer. Step 5. Set up your portfolio. Choose a pre-built portfolio or customize your own by selecting individual stocks or ETFs. Step 6. Invest in fractional shares. Use your robo-advisor's platform to invest in fractional shares. You can typically invest in fractional shares with as little as $1. Step 7. Monitor your portfolio. Regularly review your portfolio to ensure it remains aligned with your investment goals and risk tolerance. Step 8. Take advantage of micro-investing. Micro-investing allows you to invest small amounts of money at regular intervals, such as daily or weekly. This can help you take advantage of dollar-cost averaging and reduce the impact of market volatility. Step 9. Consider automated investing. Many robo-advisors offer automated investing options, which can help you invest your funds without having to manually select individual stocks or ETFs. Step 10. Learn about tax-advantaged accounts. Utilize tax-advantaged accounts such as IRAs, Roth IRAs, or 401k plans to optimize your investments and reduce taxes. Step 11. Understand investment risks. Investing always involves some level of risk. Be aware of the risks associated with investing in stocks, ETFs, or other securities. Step 12. Diversify your portfolio. Spread your investments across different asset classes, sectors, and geographic regions to minimize risk. Step 13. Set investment goals. Define your investment goals and risk tolerance to help guide your investment decisions. Step 14. Regularly review and rebalance. Regularly review your portfolio and rebalance it as needed to ensure it remains aligned with your investment goals and risk tolerance. Step 15. Stay informed and educated. Continuously educate yourself on personal finance, investing, and the economy to make informed decisions about your investments. Additional tips. Start small and gradually increase your investments as you become more comfortable with the process. Consider using tax loss harvesting to reduce capital gains taxes. Don't put all your eggs in one basket. Diversify your investments across different asset classes and sectors. Avoid emotional decision-making. Stick to your investment plan and avoid making impulsive decisions based on market fluctuations. By following these steps, you can take advantage of fractional shares and micro-investing with robo-advisors in 2024. Remember to always educate yourself and stay informed about investing to make the most of your investment journey.